advise the account the accounting implications in the preparation of financial statement for the year end 31st March 2016. When we say accounting implication, it means how this affects statement of profit and loss and other comprehensive income, how this affects statement of financial positions. Year end is 31st March 2016. This is the year end 31st March 2016. The following events have taken place after the end reporting period but before financial statement authorized for issue. This is a little bit on event after reporting period. Year end 31st March 2016. Financial statement authorized for issue 30th June 2016. 31st March 2017. This will be the next year end. A. On 31st Jan 2016, the company placed a certain deposit with a bank which is denominated in currency of country X. But this date as a deposit. Assets to be received in the number of union currency can be determined or fixed. This deposit should be considered as monetary item. All foreign currency items should be recorded in functional currency. The question says the functional currency is Hong Kong dollar. The exchange rate for $1 Hong Kong dollar against $1 country X currency on 31st Jan 2016 is 12 and 31st March is 14. 12.14. This is the spot rate. This is the closing rate. Deposit in foreign currency must be recorded in functional currency initially at spot rate, $12 spot rate. Given this, the deposit is a monetary item. This monetary item at the year end must be remeasured using closing rate. There's a plus minus. This plus minus is exchange differences on monetary item. This plus minus on monetary item should be recognized in P&L. 28 June 2016, the exchange rate have devalued to $1 Hong Kong dollar against $1 country X was 8. 28 June 2016, 8. From here to here, there's a plus minus also. This plus minus will be exchange differences. It's a non-adjusting event. It should be exchange differences arises for 2017. It's not 2016. It's a non-adjusting event. Because condition of the devaluation is only arises after the year end, not at the year end. This is a non-adjusting event. This exchange differences will only affect 2017. 5 marks. First, you must tell the marker that initial deposit will be recorded at spot rate. Because this is a monetary item, at the year must be remeasured using closing rate. There's any plus minus recognized in P&L because this is a exchange differences on monetary item. The devaluation of currency after the year before financial statement authorized for issue will result in differences, but this differences is a condition arises after the year end, not at the year end, the non-adjusting event. This will only affect 2017 financial statement. Look at suggested answer. Part A. The deposit is considered as monetary item because these are considered as assets to be received in number of union currency that are fixed or can be determined. Since the functional currency of NEC is Hong Kong dollar, this is considered as a foreign currency transaction. A foreign currency transaction initially must be recorded at spot rate. The spot rate is equal to 12. For the purpose of preparing the financial statement at the end of year, because this is considered as monetary item, this monetary item must be remeasured using closing rate, 14. Any exchange differences must be reported in profit and loss because this exchange differences of monetary item. The devaluation of exchange rate after the year end is not a condition at the year end, it's a condition arising after year end, it's a non-adjusting event. Should not be adjusted in 2016. This only affects 2017. If the effect is considered as material, the entity should disclose in 2016, but they only adjust in 2017. That's for part A. Now look at part B. NEC have ordered the purchase of certain plant equipments from overseas supplier at a price of euro 100,000 on 30th September 2015. Purchase of equipment in foreign currency, so it's foreign currency transaction. Initially, it must be recorded at spot rate. The exchange rate on 30th September 2015 is 8.65. 8.65 spot rate. The plant equipments were received by NEC on 28 February. 28 February, the exchange rate is equal to 8.83 spot rate. The relevant payable was only settled on 30th June 2016 after the year end. 30th June 2016 is equal to 8.59. At the day when they place the order, there's no entry because there's no payment made, they have not received the equipments. Pass an entry on the day they receive the equipments. 28 February 2016. 28 February 2016, receive the equipments they have obligation to pay. Debit the PPE and credit payable. Initially, it will be recorded at spot rate. Euro 100,000 multiplied by 8.83. Hong Kong dollar 883,000. When it comes to year end, this payable must be remeasured at closing rate. Euro $100 million. Based on the question, they did not give us the exchange rate at the year end. This will be translated using closing rate. X dollar. Any differences between the 883,000 and remeasurement amount at the year end, the plus minus considered as a forex gain or loss. This forex gain or loss must be recognized in P&L. The settlement was made on 30th June. It will be recorded at euro 100,000 multiplied by 8.59 spot rate at the day of settlement. Hong Kong dollar is equal to 859,000. Any exchange differences, the plus minus, the forex gain or loss should also be recognized in P&L. In this P&L is P&L in the year 2017, not 2016. For 2016, there's exchange differences on the remeasurement. This is a non-adjusting event. Because the movement of the exchange rate arises after the year end, arises at the settlement date, it's not a condition exists at the year end. It's a non-adjusting event. This amount only affects 2017. The PPE as a foreign currency transactions must initially record at spot rate. Thereafter, the PPE as a non-monetary item and is at cost basis is not remeasured using closing rate. So we take cost less depreciation and impairment losses. This will be in accordance to HKAS 16. It is measured at historical cost, should be translated using the spot rate at the date of purchase, 8.83. And this amount will be used for accounting for depreciation. Carrying amount remain at the initial amount less any depreciations. Do not retranslate because it's a non-monetary item. The payable as a monetary item initially recorded at spot rate 8.83. For the purpose of the financial statement again, payables should be remeasured using the closing rate, which is unknown. The exchange differences arising from the settlement payable on 30th June is a non-adjusting event. These differences will be recognized in profit and loss in 2017. The effect of movement exchange rate between 31st March and 30th June is recognized in profit and loss at the time of settlement, which in this case is 2017. This explains what we discussed earlier on. Initially, all will be recorded at spot rate. PPE, we have to take the cost less depreciations, and the cost is 883, we do not remeasure. Payable is a monetary item. Year end, you must remeasure using closing rate. Any exchange differences, this one recognized in 2016. When it comes to settlement, you have to record this as spot rate. Any differences will recognize P&L 2017. Earlier on, the question we discussed is more on monetary item. Can I do a little bit on non-monetary item? Take for example, on 28 February 2016, purchase of property, assuming for Australian dollar 10 mil. Initially, this purchase will be recorded at spot rate 5.0. The amount in Hong Kong dollar will be equal to $50 million. When it comes to year end, assuming it's 31st March, 1 month after the date of purchase, this is a year end, a property is considered as a non-monetary item. If it's a non-monetary item, we do not need to remeasure using closing rate unless the property is measured using fair value basis. In other words, if the property is at cost model, assuming there's no depreciation, assuming it's a land, this amount will be equal to $50 million. Because it's a non-monetary item, year end will be at cost, the cost is equal to $50 million. And this $50 million is based on the HR rate, the exchange rate used for initial recording. Assuming that if the property is at fair value basis, assuming the fair value now is equal to Australian dollar 11 million, and the exchange rate, for example, is equal to 5.1, Hong Kong dollar will be equal to $56.1 million. If the property is at fair value basis, you'll be at 56.1. You'll be remeasured using closing rate because we need to know the fair value in functional currency. In this case, we must increase from 50 to 56.1. There's an increase of 6.1. This 6.1, there are two components. One is the increase in the value of $1 million, Australian dollar 10 million to 11 million. Another component is the movement in the exchange rate 5.0 and 5.1. Where do we recognize this 6.1 gain? It very much depending on what is this property. If this property is a PPE at revaluation model, then this gain will be recognized in OCI in accordance to HKAS 16. If this property is an IP at fair value model, then this gain will be recognized in P&L in accordance with HKAS 40. This change in the fair value, including the forex exchange differences, in accordance to AS 21, if it's a non-monetary item, we apply the relevant standards. If this property is a PPE at revaluation model, we treat this as a revaluation surplus. The surplus will go to OCI. If this property is an IP at fair value model, changes in fair value will go to P&L. If the item is a non-monetary item at fair value basis, we must apply the closing rate. When any gain or loss, we must apply the relevant standard to account for the gain or loss in P&L and OCI. Generally, for monetary item, when there's any exchange differences on settlement and remeasurement, the exchange differences must recognize in P&L. But if it's a monetary item, and the monetary item is formed part of the reporting entity net investment for operations, in the financial statement of the affected entity will still go to P&L, but the group level will be recognized in OCI. Take for example, you have a parent company, investment in subsidiary. The parent company, functional currency, Hong Kong dollar, subsidiary is renminbi, functional currency. There's a loan given from parent to subsidiary. This loan is Hong Kong dollar loan. So to the parent, this is a loan assets. To the subsidiary is a loan liability. To the parent is a normal loan because it's a Hong Kong dollar loan, because parent functional currency is Hong Kong dollar. But to the subsidiary is a foreign currency loan. Must remeasure at closing rate. Forex gain or loss. This forex gain or loss will still be recognized in P&L in the subsidiary account. At the group level, this loan will be eliminated because to the group, these are intra-group balances. How about these exchange differences? These exchange differences cannot be eliminated because subsequently, when subsidiary paid to the parent, the subsidiary must convert to Hong Kong dollar. To the group, there will be exchange differences. These forex differences will not be eliminated. What do we do with these forex differences? Do we put this in P&L? Is this loan considered as part of the investment for operation? Like for example, when you start a company overseas, a lot of time you don't put all the money in share capitals. You put the money partly in share, partly in loan. If you put the money in loan, you have the right to call back, but you don't have intention to call back anytime soon. This money invested in subsidiary, but you don't call this as share capitals, you call this as loan capitals, but it's as good as share money. This will be considered as part of net investment for operation. Is this considered as part of net investment for operation? If the answer is no, it's not part of net investment for operation, then these exchange differences will stay in P&L. If this loan given to subsidiary is part of net investment for operation, if the answer is yes, then at the group level, you must reclassify it to OCI. When a parent gives a loan to subsidiary, but this loan is as good as investment in share, because they call this as loan, every year must retranslate using closing rate. Every year will be exchange differences. Last year is a gain, this year is a loss, next year will be gain or loss. But this is just the differences. These differences will not affect the cash flow of the group. In accordance to AS 21, if there's any exchange differences arises from monetary item, and this monetary item form net investment for operations, in the financial statement of the subsidiary, we still recognize in P&L. By the group level, it's just the differences. We must take out and put in OCI. If the monetary item represent part of net investment for operations, in the financial statement of the affected entity is still in P&L. By the group level, will be reclassified to OCI. This is the exception I'm talking about just now. So far we discussed financial statement must be prepared in functional currency. How do we determine what's a functional currency? We must consider the factors. Secondly, we discussed if you have a foreign currency transaction, it must be recorded in functional currency. When you record in functional currency, you need to know what exchange rate to use, how to account for forex differences, depending on whether it's monetary item or non-monetary item. Now we talk about translation of financial statements. Translate from one currency to another currency. We have to consider what exchange rate to use, how to account for forex differences. It depending on why do you do the translations. You do a translation, is it because you want to prepare the financial statement? You do the translation, is it because you want to present the financial statement? Prepare and present is different. Financial statement contains of 5 elements: assets, liability, equity, income, and expenses. These are financial statements given to us. For example, this is in A currency. Now we need to translated financial statements to B currency. What exchange rate we are going to use for all these items for the translation? After translation, there's a forex differences plus minus. These forex differences, do we recognize in P&L or do we recognize in OCI? To answer this question, we need to know what is the translation for. Is the translation to redo our financial statements, or is the translation because we want to present our financial statement? Please refer to page 301, Translations of Financial Statements. The first type of translation is from foreign currency to functional currency. This type of translation is translated to prepare financial statement. The scenario is this. AB functional currency is B dollar, but AB prepare its financial statement is A dollar. The financial statement of AB in A dollar is non-compliant with FRS because the financial statement is not prepared in functional currency. The functional currency should be B dollar. Now we have to translate from foreign currency to functional currency to redo our account in functional currency, re-prepare our account in functional currency. The financial statements in A dollar, this is non-compliant with HKAS 21. For example, country X, and the government in country X want this company to prepare the financial statement in local currency for tax purposes. If you're in that country, your financial statement must be in the local currency. But the company functional currency is not local currency. The functional currency is B dollar. But you still have to prepare the financial statement in local currency because of tax purposes. To comply with AS21, you must re-prepare the financial statements in B dollar. This type of translation is tedious. You have to go back to redo the account. One transaction 3 years ago, you must use 3 years ago exchange rate. You have a transaction 30 days ago, you must use 30 days ago exchange rate. Every transaction must be re-recorded. Generally, all these must be re-recorded using the HR rate. Income expenses are income expenses for the year. You have 1,000 or million transactions for the year. Especially in exam, we cannot redo each transaction at HR rate. For income expenses, if it's practical, we use the HR rate. If it's not practical, we use the average rate. If the examiner gives the exchange rate, then it's practical. If the examiner do not give the exchange rate, it's impractical. For equity are example like issue of share, payment dividend. Normally, not many transactions a year. For equity, if there's an issue of share, payment dividend, the question will tell you average date. For equity, normally you can use the HR rate. For assets liability, you must differentiate whether it's non-monetary and monetary assets liability. For non-monetary assets, like for example, machine, you purchased the machine 3 years ago, you should know when you purchased this machine because you should have an assets register to keep track the purchase of this machine so that you can depreciate the machine over the useful life. For non-monetary assets liability, normally it's practical for us to use the HR rate because normally in a year there are only few transactions. Monetary assets liability, technically we should use the HR rate. But even use the HR rate, you still have to remeasure using closing rate. Instead of using the HR rate, remeasure using closing rate, we straight away use closing rate. Instead of doing 2 steps, we only do 1 step for monetary assets liability shortcut. So after that, this is the translated amount. There should be plus minus. And this plus minus is an exchange differences because of monetary item. Non-monetary item, all this will be at HR rate. That means you purchased the machine 3 years ago, use 3 years ago, exchange rate every year. Non-monetary item will not give rise to differences. Only the monetary item give rise to differences. Because you have a differences, it's mainly due to monetary item. When there's any exchange differences due to monetary item, it must be reported in P&L. This type of translation, I would say, is not common. Even the examiner asks question on this, normally the examiner not ask you to do the translation of financial statement. The examiner asks you to do 1 or 2 transactions, that's all. You translate from foreign currency to functional currency to redo the account. This type of translation is not common in exam. What is common is this one. This is a translation from functional currency to presentation currency. This is not to prepare the financial statement. This is to show the financial statement in another currency. This another currency for presentation purposes, we call this as presentation currency. Company can have only one functional currency, but you can present your financial statement in any currency you want. Take for example, AB prepares financial statements in functional currency of A dollar. The financial statement of AB in A dollar, this is compliant with AS21. Now you want to present in B dollar, translating the financial statements because you want to show in another currency, from functional currency to presentation currency. This is very common in practice. For example, AB is the parent company, investment is XY. This is the parent, this is a sub C, 100% owned. The parent functional currency is Hong Kong dollar, and the functional currency XY maybe is equals to renminbi. If there's any transactions, it will be plus minus in renminbi. We have to prepare the group account. The group account is in Hong Kong dollar. Normally that's the case. Do we still consolidate? We still have to consolidate as long as you have control. But before you consolidate, you have to translate from renminbi to Hong Kong dollar. You want to show in Hong Kong dollar because we need to do consolidation. We must make sure we have a common currency. Then we can do a consolidations. This type of translation is not translate because you want to prepare. This type of translation to show in Hong Kong dollar much easier. All income expenses, we don't care what kind of income expenses because we are not recording the income expenses. We are just showing the income expenses in another currency. Not recording but showing. All income expenses will be translated using the average rate. Equity here are referring to the net assets at initial translations. That means the first time you do translation. To do translation first time because you need to do consolidation at the acquisition date. This will be translated using the HR rate. The assets liability, when translate from functional currency to presentation currency, you don't care what kind of assets liability. We are just showing it in another currency at the year end. So you must use the closing rate. Add all this figure, there will be plus minus again. This plus minus is just a differences. When we translate from renminbi to Hong Kong dollar, and there will be a differences. This differences is a translation from functional currency to presentation currency. Does these differences affect XY? Answer is no. Because XY functional currency is not Hong Kong dollar. XY functional currency is renminbi. If there's any exchange differences, the exchange differences is already recorded in renminbi. These differences do not affect XY. Does these differences affect the cash flow of the parent? Answer is no, unless the parent disposed the investment. If the parent disposed investment, then affect the parent. If the parent did not dispose investment, every year is just a differences. Last year is a gain, this year is a loss, next year is a gain or loss. It's just a differences. In accordance to AS21, these differences will be reported in OCI at the group level. These differences must be recognized in OCI. When the parent lost control of that foreign operation, do a reclassification from OCI to P&L. Please refer to page 303, question 10.1. We look at how to do the translations of a foreign subsidiary from functional currency to presentation currency using the translated financial statements to prepare the consolidated financial statements. Study the questions, understand the issue. We're going to discuss this question shortly. We are required to prepare the consolidated statement of financial positions at 31st December 2016. Do this in the form of a worksheet. We are now at 31st December 2016 with these two companies, AAL and BBL. And pay attention to the currency. This is Hong Kong dollar, this is Malaysia ringgit. AAL is the parent, BBL is a subsidiary. This subsidiary with a functional currency is ringgit. This represents foreign operations. AAL acquired 100% of BBL on 1st Jan 2016 at a cost of Malaysia ringgit 110, when BBL have a share capital of 20 ringgit and 70 ringgit. To AAL, BBL is considered a subsidiary. 100% give us control. 1st Jan 2016 is acquisition date. The date we obtain control is the date that we have to do consolidation for the first time. The cost is equal to 110 ringgit. But be careful, this is ringgit. The functional currency of parent is Hong Kong dollar. To the parent, this is considered as a foreign currency transactions. If it's a foreign currency transaction, initially it will be recorded at spot rate. This will be recorded at 110 multiplied by, at the date obtaining control, the exchange rate is 1.9, the HR rate. And we're also given the exchange rate at the year end, 1.82, consider the closing rate. And we're also given the average rate for the year, 1.88. This investment cost is recorded by the parent based on the spot rate. On the day the parent acquired subsidiary is 1st Jan 2016. On 1st Jan 2016, the exchange rate is equal to 1.9. 110 multiplied 1.9 is equals to 209. In the separate financial statements, this amount is accounted for at cost. If you have control, you must consolidate 100% as usual, and we must plus minus the consolidation adjustment to prepare the group account. We cannot just add it up in this case because they are not in the common currency. In order for us to consolidate, make sure they are in common currency. We must translate from Malaysian ringgit to Hong Kong dollar. This type of translation, we call this as from functional currency to presentation currency. The question mentioned that BBL operate independently. The functional currency for BBL is Malaysia ringgit. Malaysia ringgit is the functional currency of BBL. Now we have to translate from ringgit to Hong Kong dollar. It's a translation from functional currency to presentation currency. For this type of translation, all the assets liability will be translated using closing rate. The closing rate is equal to 1.82. The share capitals and retained earning, these are considered as pre. The day when the parent obtained control of subsidiary for the first time, that's the first time we must do translation. This will be translated using the HR rate, 1.9, 1.9. And $10 is a profit for the year. Profit is income minus expenses. From functional currency to presentation currency, this will be translated using the average rate, equals to 1.88. We have to translate, then we consolidate. Here's the just answer. Next page. This is ringgit, the translations from functional currency to presentation currency. This is the translated column. 100 multiplied 1.82. 1.82 is considered the closing rate. Share capitals and retained earning, these are share capital retained earning at the acquisition date, translated using the HR rate, equals to 38,133. And this represent the profits for the year. From functional currency to presentation currency, this will be translated using the average rate. That gives us 18.8. This $100 is the total of this, equals to equity. Equity is equals to the net assets. You can see from here, $100 net assets. You can simply take the $100 multiplied 1.82 closing rate. 100, 1.82 equals to 182. This 182 is this 182. It's the same. The net assets now is 100. This 100 is translated using 1.82. It's the same 100 here. After that, you have to calculate the balancing figure. There should be a difference of 7.8. This is the translation differences for the year on the net assets of the subsidiary, 7.8. First step, we must translate from functional currency to presentation currency. All assets liability will be at closing rate. The equity at the acquisition date will be HR rate. Profit or loss for the year will be at average rate. After translations, you have to calculate the balancing figure. This represents the translation differences on the net assets. When we do the consolidation adjustment, the first adjustment is always for us to calculate goodwill as the pre. We look at this now. On the day when the parent obtained control, the share cap is equals to 20, the retained earnings is equals to 70, added up is equals to carrying value net assets, represent ringgit 90. And the question mentioned at the date of acquisitions, the fair value underlying assets was 15 ringgit more than the carrying amount. 15 ringgit more, adjust up. So there's an increase of 15 relating to PPE, plant. The plant have a remaining useful life of 5 years. When we increase the value of the assets, we must increase the depreciation over the 5 years. 15 over 5 years, 1 year will be equals to 3 depreciations, post-adjustment. The goodwill was impaired by 40% at the year end. When the goodwill is impaired, meaning that there must be a goodwill, then we must adjust the goodwill down by 40%. Take note for this later on. As mentioned, we have to do the consolidation adjustment. In order for us to do the consolidation adjustment, you must have a set of working. Working 1, working 2, and working 3. We'll look at working 1 first. Calculate goodwill of BBL. There's only one way to calculate goodwill. You must apply HKFRS 3, acquisition method. We have to take the cost of control. In this case, it's 100% owned. Do we take the cost based on ringgit or based on Hong Kong dollar? We are going to calculate the goodwill. Goodwill is an asset of the subsidiary. It must be expressed in the functional currency of subsidiary. Meaning is that we have to take ringgit, go to 110, the cost. NCI in this case is 0, not applicable because it's 100% owned. We have to less the fair value of net assets of BBL, take the share cap 20, retained earnings is 70, and there's a plant assets is 15 increase. In total is equals to 105. This 105 represents the fair value net assets. 110 minus 105. Goodwill is equals to ringgit $5. This is for working one. This goodwill must be expressed in the functional currency of the subsidiary first. After that, translated into presentation currency of the group. We have to know what's exchange rate. All these will be translated the first time when we do consolidations at the HR rate when the parent acquired the subsidiary. All these will be translated 1.9, 1.9, 1.9, 1.9, and this 1.9. 110 multiplied 1.9 is equals to Hong Kong dollar 209. Take this, multiply this, Hong Kong dollar 38, Hong Kong dollar 133, and Hong Kong dollar is 28.5. If you add it up, it's equals to 9.5. This 9.5 is based on 1.9. All this will be translated the first time because the first time we obtain control, the first time we do translations. All this will be translated using the HR rate at the date when the parent will obtain control. This is the first adjustment entry we must always pass. Adjustment entry number 1. We have to eliminate the investment cost, credit, eliminate the share capital retained earning, account for the plant assets, the difference is goodwill. That's the first entry to calculate goodwill of the subsidiary. First, it must be expressed in the functional currency of the subsidiary. After that, translate into the presentation currency of the group. Then you pass the journal entry using the presentation currency. Use this figure for worksheet. The first adjustment entry will be 1. We have to eliminate the cost of investment. We must account for NCF, but there's no NCF for these questions. We must eliminate share cap retained earning, perform fair value adjustment. The balance is goodwill. This is the first entry we always pass to account for subsidiary for the first time. This is the pre. After the pre, we have to do the post. When you increase the value of the assets, you must increase the depreciation assets. We'll look at second entry, entry number 2. Now I'm looking at this row here. Number 2 is talking about plant assets. Again, it must be expressed in the functional currency of the subsidiary at the acquisition date. Initially, it's at 15. First time translated using 1.9, the HR rate, is equals to 28.5. When you increase the value of the assets at the acquisition date, you must also increase the depreciation of the assets after the acquisition date. Depreciation to profit and loss. Do we make adjustment based on this figure, functional currency, or do we make adjustment based on the presentation currency? When making adjustment or making adjustment to the assets of the subsidiary, you must use the figure at the functional currency of subsidiary. You should not be using this figure, presentation currency. Take ringgit 15 over 5-year remaining useful life. Every year you must increase depreciation by $3. After the depreciation adjustment, the plant assets at the year end at 31st December 2016 is equal to 12 ringgit. This is in the functional currency. When you need to adjust your plus minus in the functional currency of subsidiary. After doing adjustment, then we talk about translation. Translation is to show in another currency. It's not to adjust in another currency. It's not to record in another currency. Depreciation is an expense. Expense will be translated using average rate. The plant assets at the year end is the assets. Assets will be translated using closing rate. Average rate for the year is equals to 1.88. The closing rate at the year end is 1.82. Multiply. Hong Kong dollar is equals to 5.6. The closing balance for the plant assets to be depreciated over the remaining 4 years is equals to 21.8. The next step is to calculate the balancing figure. 28.5 minus 5.6 is equals to 22.9. 22.9 we must adjust to 21.8. There's a difference of 1.1. It's a minus. Reduce assets. It should be a loss. This represents a translations loss. This year is a loss, next year may be a gain or loss. This is just a differences. At the start we translate using 1.9. At the year we translate using 1.82. When it comes to next year, it may be translated based on 2. The differences will be there. Every year we do consolidations. These are differences we do not recognize in P&L. We have a differences of 1.1 translation loss. This translation loss will be recognized in OCI. Depreciation is recognized in P&L, but the translation differences is recognized in OCI. We must pass an entry for this. Entry 2. Second entry is to reduce the plant because of depreciation, to reduce the plant because of translation differences. Debit profit and loss for the depreciations, 5.6. Debit of OCI, translation loss, 1.1. Credit PPE, which is equals to the total of these two, 5.6 plus 1.1 is equal to 6.7. This entry you have to pass for number 2. Show this on the worksheet. We must adjust the plant for 2 items. First, we must reduce because of depreciation to P&L. Second item is to reduce the plant because of translation loss. Total adjustment of plant is equal to 6.7. Entry number 3 is to adjust goodwill. Earlier on, we took out this amount and show it as working 2. First, we must account for the depreciation adjustment. The second one, we have to do the translation differences. The next item that we have to do is goodwill. We take the goodwill down